Okay, time to get started. If you remember, if you were awake for Stu Hoffman's presentation, he said that one of the most important aspects of a potential recovery, of course, is the housing market. And we economists have always kind of talked about housing as about the only thing that consumers engage in, housing's expenditures that are interest sensitive. The monetary policy's only thread really to the real sector was through the housing markets, and we had, of course, housing cycles. So we decided, since housing is such an important piece of the economy, you should hear directly from the people who are involved in that. And so we got the chief economist for Fannie Mae to agree to come up from Washington and tell us, what it looks like from the GSE's point of view. So, Doug Duncan.
Thanks, Bill. It's a pleasure to be here, but I have to tell you that I heard the word expert being used earlier. My mother tells me that's actually two words. An X is a has-been, and a spurt is a drip under pressure. So I'm only going to claim to know a little bit about housing, maybe some housing finance. Catherine Mann pointed out to me that the Economist has an article, and I'm working for what they called one of the ugly twins of finance. So, there is reputational risk involved. I did want to tie together a couple of things that were said earlier and work along the theme of monetary policy in thinking about the housing market. And I will give you my view, which is not far from Stu's view on where housing is. But if you think back to the array of policy decisions, both monetary and fiscal, that were made, they were based really on an assumption that house prices are autoregressive and mean reverting, meaning that if they overshoot on the upside, they're then going to overshoot on the downside, maybe more than once each, before they settle back to some sort of a long-term fundamental. And so you may have seen recently some questions arising, are we in another house price bubble? Because you've seen some markets very rapidly accelerate in price. So I'll talk about that a little bit. But clearly, the Fed intervened in the first time in its history that it purchased assets outside of the Treasury market with the specific intent of changing the functioning of that particular model or market, and that certainly has effects. Even as recent as a couple of days ago, the Office of the Inspector General at FHFA is taking a look at what could be interpreted as the impact on MBS and interest rates in the mortgage space based on QE3. So there's additional work taking place there. And one of the other things that underlies the Fed's view is the view of whether or not they could affect the wealth effect and change macroeconomic activity by the equity wealth that households have in their home. I'll tell you, I'm a skeptic of that. There are two papers done recently that are worth reading on that question, one of them by Bob Schiller et al., and the other one by Chuck Calamiris et al., which take opposite points of view, one claiming there is a significant wealth effect, the other claiming there's none, and both, I think, are pretty strong and interesting papers worth taking a read. I'm somewhat skeptical, in part based on the surveys work we've been doing about consumers and their attitudes. We survey 1,000 households a month, and we are targeting their views on housing, but we put it in context of their macro view, their personal financial situation view, and then what they think of what's going on in housing. And they're pretty attuned, at least now, to what's actually happening in the market, and it's not clear to us that some of the conservatism that's emerged at the household level would indicate they're likely anytime soon to activate that equity from a consumption perspective. I did want to note that Dunk and I live now, we have places about 10 minutes apart from each other in Cape Coral, Florida, so we're on the water, not underwater. And Dunk was talking about small business employment. We actually did a study looking at the employment in the construction industry pre-crisis at the peak when we were building about 2.2 million units of manufactured housing, multifamily housing and single-family housing. And then what we think will be demographically supportable in terms of housing construction, in our view, is that the rest of the economy will have to pick up about 1 million jobs that won't exist in the construction trades. So that will be a hurdle that the economy will have to face going forward. And Stu talked briefly about his daughter and her peers and whether they were going to be interested in housing in the same way. Our survey would indicate that the aspiration to own a home is the same as it's always been. But as I said, there's a conservatism that's emerged that's done 2 or 3 things. One's, it's eliminated any stigma from renting. Households, young households say it's a great way to get prepared for ownership because we first of all have to get our credit in shape, and a lot of us have student debt. And not only just to acquire the house, but also to keep the house once we've acquired it. So there is more financial conservatism, and the reasons to own a home are almost all exclusively at the top, qualitative issues, not financial issues. So there's been some changes in our view on that. Interestingly, the younger cohorts that could be in home buying age are the most optimistic about the long-term investment value of homes, which is interesting, much more so than others, maybe because they weren't in the ownership space and didn't suffer the foreclosures or things like that, but also have recognized that there's been obviously a significant reset in house values. And a friend of mine, Josh Rosner, wrote a paper in 2000, which is still relevant today, I think, in which it was entitled, I may get the words a little bit wrong, but it was basically a homeowner with no equity is a renter with leverage. And that really turned out to be true in the course of the crisis. It was a very forward-thinking thing. So when you talk about the homeownership rate, the fact that there's still several million households that are underwater, you can debate whether you should include them in the homeowner category or not, because they're in essence renters with leverage against the lenders who hold those loans, and we have a couple of them. With regard to the comments on by Bill and Andre, it was a very interesting discussion. I would point out we're in the 58th month of this economic expansion, which is the average length of all economic expansion since World War II. So the law of small numbers maybe would say that the risks will rise going forward. There's a lot of reasons to believe that we won't see a recession soon. But there are reasons, if you're a risk manager, to give some thought to what happens. Given where monetary and fiscal policy are today, what would be the response? And how would markets respond if there were such a reversal? I tend to agree with Bill that monetary policy can't fix some things it's being asked to fix, and perhaps the Fed has a couple of other things to communicate. I pointed out to the Fannie Mae board a year ago in February when the minutes were released and said that there had been a discussion about the need to discuss the end of the securities purchases. There were 4 days of instability in capital markets with that release of the minutes. So they only discussed the need to discuss. Then we saw in May, when Chairman Bernanke started the discussion, 100 basis point run up in mortgage rates. So it was interesting to me that in the most recent minutes was the first instance in which a member noted that they would also have to discuss what they were going to do about the size of their balance sheet. Now that didn't generate the instability, but it was also noteworthy that finally it's going to get on to the discussion, and there was a good discussion previously about that. The one thing I would add to what Bill and Andre said is it's not just the size of the balance sheet and its composition, but it's also the duration of that balance sheet. Well, what they choose to do in terms of how they restructure it from a duration effect will have some impact on the yield curve and expectations going forward too. So I think that's something that we'll be looking for in terms of commentary from the Fed. One other thing I would note with regard to housing and monetary policy is we and Denmark are the only 2 countries that have a long-term level payment, fixed interest rate mortgage market with the option to prepay. And there are some downsides to that from the conduct of monetary policy. if you have an adjustable rate market, which the majority of the world does, you get very near-term impacts on household balance sheets when you ease and when you tighten. But in our market, to get that transmission to the household has to undertake a cost. So, for example, from a very practical perspective, we were obviously a big player in the HARP program, the Home Affordable Refinance Program, and we could look into our portfolio and see who was eligible and see that lots of those households were not undertaking the opportunity to lower their mortgage payments. So we asked them why. We surveyed, in part of this survey work was, why are you not doing it? Well, there was a broad array of misperceptions, for one thing, about whether they were eligible, whether they had to bring money to the table, all those kind of things. But we also asked, if you're employed, what is your view about whether you'll still be employed 6 months from now? And 26% of the people that had a job were worried that they would be unemployed within 6 months. So if you think about the practical transaction that takes place when the homeowner sits across the table from their lender, the lender says, we've got a great deal for you. All you have to do is sign this piece of paper, and we are lowering your mortgage rate by 150 basis points. So that householder that is worried about losing their job in 6 months says, well, are there any fees involved? And the answer is, depending on where you live, it varies, but take a number, $4,000 in fees that you have to pay. A lot of them are pass-throughs for title insurance or things like that. So they're going, let's see, so I save $150 a month, but I'm for the next 6 months, so that's about $900, but I pay out $4,000 up front, and then I lose my job. I don't see how that's a good calculation. So there's some practical aspects related to the way our market is structured and the way monetary policy is transmitted to the household level that that lead you to consider at least whether what the aspects of the future structure of housing policy should look like and what assumptions you make about what we should include. So with that, just let me very quickly, there's a whole bunch of charts in here. And I'm not going to talk about very many of them. Basically, it's the titles of the pages that I'm going to talk about. That basically just says Fannie Mae will deny I was ever here. I give them good reasons to make me include disclosures. Anyway, with regard to housing demand, the questions in housing demand are really, will there be sufficient organic demand, that is, growth of households with the income to be capable and the interest to buy homes to replace the institutional investors who swept the bottom of the market and are now largely no longer a significant component of demand. That's the big question today. And our forecast, so that you know, is for existing home sales to be about 1% lower in 2014 than they were in 2013, but new home sales to be up maybe 15 to 20% or thereabouts. So on balance, a flat market in 2014 versus 2013. Now, I'll talk, well, actually let me take this moment to talk about interest rates and how that's had an impact. So last night at dinner we were talking about the 1994 episode where the Fed raised rates a significant amount. I think it was 225 or 300 basis points in something like about 18 months. And what happened to housing in that time period? Total home sales fell. House prices rose, just not as fast. And there was a spike to about 60% of applications being adjustable rate mortgages. In 1999-2000, there was another episode where mortgage rates ran up about 180 basis points over 19 months. Home sales flattened. House prices rose, just not as fast. And there was a spike to about 40% adjustable rate mortgages. So this time, mortgage rates rose about 100 basis points in less than 6 months. And they've sort of stayed there. And the use of adjustable rate mortgages went from 2% to about 7%. And they're all jumbo and going on bank portfolios. So what's different? The rules for underwriting an adjustable rate mortgage were changed so that now you have to underwrite that loan at the maximum rate to which it can reset in the first 5 years of its life. So whereas households were using that as an instrument to ride the yield curve and manage affordability, that's been taken away from them. from an underwriting perspective. They can still take it if they can qualify at that maximum rate. They can still use it, but it's very clear to see that the appetite for that tool, because of that regulatory change, has altered dramatically. So that's led us to downgrading our forecast relative to what we might have thought previously. So that kind of gives you a financing regulatory change aspect to impact on housing demand. We do think new home sales will continue to grow, but let me talk for a moment about supply, which we believe constraints in supply are the reason that you've seen the significant increases that you have seen. It's almost all supply driven from our perspective at this point. New home supply has, let's see, where new homes are the green line in the upper right, and you can see they've just barely turned up relative to the bottom, and they're well below the long-term averages, and significant ways to go. So what's going on in construction? Why so few? So last year, at the beginning of the year, we came out with a forecast of 950,000 starts, and the board of directors called me in and said, "Why are you such a pessimist?" And I said, actually, I'm a realist. I grew up on a dairy farm. People would ask my father, "Charlie, are you going to have a good crop of corn this October?" And he'd say, the first thing that has to happen to get a good crop of corn in October is that the tractor has to start in March. So what we did was we went from 2.2 million starts annually to 600,000. So we essentially destroyed the supply chain in housing construction. So if you're going to build, the first thing that you have to do is you have to probably get credit, or if you don't need credit, you have to get land. To survive that downturn, all the public builders sold land or released options on land, and land development and preparation came to a halt. And that was about a 4-year time frame over which that happened. Also, you laid a bunch of people off. The credit conditions tightened through the regulatory process in banking, and all the input suppliers stopped creating significant amounts of input or of supplies. So first you may have to get credit, then you get credit, you have to find land, then you have to permit that land. Some jurisdictions in California that can take 3 years. Then you have to hire the labor, which mind you has been laid off 4 years ago, and then input suppliers have to ramp up. All that has to happen before you start to see the production chain on housing. So we said, we just don't see how you get to, I think the consensus of forecast was 1.1 and 1.2 million. So we just don't see how you get there. And so as it turned out, I think 923,000 starts last year. So our forecast for starts this year are 1.05, 1,050,000, so up a little bit, about 100,000 units. We'll see the weather clearly impacted the ability to start in some regions. So it could well be that might be an optimistic forecast for this year. But I would say the risks are on the downside rather than the upside from that. So thinking about longer term demographics, I think, Bill, you mentioned maybe a number of 1.5 million being for total starts or construction might be a reasonable number. I wouldn't really quibble with that. But if we only get to 1,050,000 this year, we're a long ways from normal, and it's hard to see how you get there real soon, at least another 2 or 3 years. And of course, that's 2 or 3 years past the average length of an expansion. So it does raise questions about the risks in the market. Home prices, obviously everyone is aware they are up. We think they will increase this year at about half the pace of last year, somewhere in the neighborhood of 4.5%. But if you think about home prices long term, since World War II out to about 2000, the average annual nominal increase in house prices nationally was about 4%. In real terms, it was between 0.5 and 0.75%. If prices increase 4.5% and inflation runs at 1.5%, that means real prices are rising at about 3%, which, if you think about credit-constrained households and the fact that income growth has been very slow, that does create a headwind for housing to grow more rapidly. So we still see those house price increases as driven primarily by supply side considerations, constraints in supply. You can pick a different number. If you like a higher house price appreciation, there's a bunch of choices that you have there Ours is pretty close to the CoreLogic. So for last year, I think CoreLogic had just under 12% appreciation. Ours was about 10 and a half, something like that. Obviously, there's been underway a rebalancing between owning and renting. We do not buy the argument that we're becoming a nation of renters. We're saying we got way ahead of where we should have been from a demographic perspective in terms of the home ownership rate. A 64, 65% home ownership rate is pretty reasonable to us, and we're pretty close to that. 69% was sort of ridiculous, and that was a part of the adjustment process that's taken place. The most rapid growth component of the rental market is the one-unit properties that are being transferred through arbitrage from the foreclosure process into the rental market, and those institutional investors did a valuable service to the market in helping that transition. Our view is that they will likely exit sometime in the next 5 years or so because they have some significant rate of return targets, combined cash flow plus capital gains that are not normally there. In fact, there's never been an environment in which that was a significant broad-based opportunity, because typically at the end of a cycle when there's the downturn, prices don't fall in the way that they did this time. But this event created enough of a gap that they could acquire the properties at a low enough price that they could put some rehab money into it, get good rents, and see a capital gain to achieve a 22 to 25% after-tax targeted return over, say, about a 5-year period. So we've started to see them start to lay off the risk. Some are securitizing rents. Others are putting out REITs. So that, to us, seems like a pretty normal environment. The typical owner of those one-unit properties is somebody who bought a starter home, had children, bought another house, and kept that one as a rental. Or a local doctor or a professional of some sort that is diversifying their income by owning 2 or 3 rental houses in their neighborhood, which they know and understand. That's always, the 1 to 4 units is 55% of all the rental units in the country. So this is not new. This is long run. People just haven't really focused on that issue. 50 plus units are only 25% of all the rentals in the United States. Let's see if I can. I did it, huh? On that farm that I grew up, my father used to say, if it has more than 2 moving parts, don't call Doug. And this is a demonstration of why he would say that. He was right, by the way. Okay, just as long as I don't have to repeat everything. Thanks. Demographics, there was comment earlier about who's living at home. The highest proportion ever of 25 to 34-year-olds living at home with their parents. Both parties to that transaction find it adverse. And so that's the households that are waiting to unfold if we see the job growth and the income growth that will allow them to establish their own homes. I have the immigration piece in there for 2 reasons. One, we took the 2008 current population survey and projected the 2050 workforce. Then we took the 2012 current population survey and did the same thing to try to see what was the impact of the recession on the prospective workforce in the future. So we had a housing interest, but we also had an entitlement interest. The answer to that question was the drop in immigration was so significant that we would have 15 million less workers in 2050 than we would have thought using the 2008 data. So think about the difficulty of reforming entitlements with those 15 million less workers, and that all comes out of the demand side of the equation for housing as well. So more to come on that, but we've kind of been pointing that out, and it is regionally impactful, particularly in the border states, and there are about 11 gateway cities. One of them is in the Midwest, Chicago in particular, that will be impacted by that. In terms of mortgage credit, there's a lot of discussion about whether credit conditions are too tight. If you array by year of origination the cohorts of mortgage originations for the last 20 years or so and look at the early payment default characteristics, that is, the first few months of their life, how many of them go delinquent, you will clearly see that credit conditions from that perspective are very tight. There's no doubt about that. Are they too tight? Well, it depends. There's that old joke about the two married male economists walking down the street, and one of them asks the other one, "How's your wife?" What's the proper answer for the other one? Compared to what? Right? I mean, these are economists after all. So, but that's kind of what would you like to see as appropriate underwriting criteria? That's really the question in terms of credit conditions. So let's talk for a moment about loan quality and then who's holding the portfolio, the loans in portfolio. So clearly, loan quality in the current origination since, say, the 2010 period going forward, very pristine, very low levels of delinquency and foreclosure. That goes along with the credit tightness discussion. The legacy loans are working off. Delinquencies are coming down significantly. Both in terms of the early delinquencies, they're falling significantly. It varies. The work through of the foreclosures vary depending on whether a state has a judicial foreclosure process, that is, judges have to make decisions on when the foreclosure is complete, versus administrative, which is there's a set program that runs on a clock. And in those states which are administrative, they're coming much closer to normal levels. But the judicial states, of which Florida is one, still takes something on the order of 1,000 days to work all the way through the process. There was an interesting Federal Reserve study recently that shows that households who are in the foreclosure process are using that time period of not paying their mortgage to release their credit card debt, which I thought was an interesting sidelight of the process. Now, if you look at who holds mortgages, and it gets to the policy question related to Fannie and Freddie, to go back in history, commercial banks hold whole loans in a very narrow band. And that's true for some 60 years. Never less than 15% of their assets, never more than 20% of their assets. For those policymakers that think that the banks will pick this all up, I would suggest, particularly if you restructure things to require the existence of a 30-year fixed rate mortgage, you're going to be disappointed by the bank participation in that. So that's a fundamental question that you have to ask first is, do you believe we should still have a structure which supports a 30-year fixed rate mortgage? And if so, then who's going to hold the loans? So the loans went from the thrift industry to Fannie and Freddie's portfolio and now to the Fed and to some foreign investors. So the question is, what happens after that? So that's the end of my comments. That's perfect. Okay.
All right, quick questions? No questions. You were so good. Well, there's a gentleman way in the back. We don't have a microphone there yet, so we don't have one at Stu yet either, so.
As someone who owns those single-family homes, and I rent out, my average renters are in their late 20s, early 30s. The thing that shocked me over the last few years is the amount of student debt my tenants have, to the point where, like, I actually worry about them paying the rent. So, like, I have a tenant, Lily has $200,000 of student debt. He's 30 years old. I don't see how he ever buys a house.
Yeah, one of the regulatory responses through the CFPB was to establish minimum debt-to-income ratios on the back end for qualification, and something to think about in monetary policy related to that is that the housing cycle has always been highly calibrated with the total business cycle of the economy, but there's never been a fixed floor in the underwriting within the mortgage space. So to the extent that housing functions in relationship to its funding now there will be periods in which there will be a floor in that debt-to-income ratio that will perhaps change the cyclical relationship between housing and the macroeconomy. And student debt is a big driver of that debt-to-income ratio.
Stu, you can have one loud question. Here, wait for the microphone.
And talking about the supply chain to, build homes, you feel the same way about remodeling? I mean, if you can't permit land and, there's sort of a supply constraint, people whose families are expanding or whatever, their next alternative is to remodel, fix up. And so I would think there might be some better prospects for remodeling rather than building new homes or moving to a new home.
Yeah, you've hit it. It's a combination of mobility. It's having an impact on mobility because people that are underwater in particular and don't see for a while that they're going to come out for underwater will fix up their habitation. And those who may just choose not to ever give up the mortgage that they've gotten at 3% now. And you see that reflected in the stock prices of Home Depot and Lowe's and other suppliers to people in the home repair market. Definitely has picked up. Absolutely.
Doug, thank you very much.
Thank you.
Well, some people say that the Fed is the world's central bank, so it's appropriate that we have Mickey Levy from Blenheim Capital Management talk about the Fed in a more global context. Mickey?
Dunk, it's a pleasure to be here. In my limited time, I'm going to briefly go over the Fed, the ECB, the BOJ, and the Bank of England, look very quickly at their objectives and challenges. And starting from the top, the Fed is the only central bank that has a dual mandate, low inflation, high employment, while the other leading central banks have a single inflation mandate. What has been characteristic of all of them and their economies is they have slow economic recoveries. Of course, Europe, their recovery was interrupted by recession. And with the exception of Japan, inflation has been below target. As I'll describe, inflation has increased and replaced deflation. And I think it's very important to point out that all central banks have been pursuing unconventional monetary policies, somehow defined, and all of them in different ways are under intense pressures to achieve broader government objectives. And that's absolutely clear for the Fed, but if you think about the ECB, it's been pushed into being almost a lender of last resort. But the list goes on, and I can't emphasize enough how much I agree with Bill Poole's notion that the Fed and these other central banks have been pushed to broaden the scope of monetary policy way beyond the normal scope. So at the current juncture, what is the appropriate policy response for each central bank? And I'm going to talk about the economies, but and the challenges these central banks face, but to summarize my view, I'm urging that the Fed proceed quickly, much more quickly than they're now giving indication, toward monetary policy normalization. I urge the Bank of England to start hiking rates and normalize policy. A little more controversial, I'm recommending that the ECB allow its LTRO to expire and replace it with a quantitative easing. And then for the BOJ, it's difficult to distinguish between what they ought to do and what they're likely to do, because it has totally lost its independence. It's absolutely under the thumb of the Abe administration, and it's likely to enhance their quantitative-qualitative easing. And so a lot of the focus now is on inflation in addition to economic conditions. And it's interesting that, I'm going to jump ahead, inflation, looking at core inflation in the different countries and regions, they've all converged toward 1%. In Europe, inflation is a little below 1%. In the U.S., a little above. I might note in the United States, the core CPI is about 1 3/4, but the Fed looks at the PCE deflator. And even in the UK, inflation's come down slightly below its objective. Now, it's 2% objective. Now, every one of these central banks is forecasting inflation to go to 2%. Now, what are the economic and financial conditions underlying these forecasts? Stu and others have talked about the economy. If we look at the U.S. economy, it's behaving almost normally, but it has high unemployment. As Bill Poole said, the business investment is underperformed, but in many ways it's behaving normally. Balance sheets, both household and business balance sheets, have improved dramatically, and many of the earlier economic and financial imbalances that had existed up until the last prior expansion peak have been reduced. I think I'll take the overside on economic growth in the U.S. I think it's going to surprise to the upside. Eurozone, whereas the U.S. is completing nearly its 5th year of economic expansion, the Eurozone is 1 year into a fairly fragile recovery following a deep recession, then a rolling financial crisis. It's also clearing up excesses and imbalances and it's finding it very, very painful. And now it's addressing, and I think properly so, banking reform. Japan, the economy's growing. In fact, it's growing faster than its potential, but there are tons of uncertainties. It's trying to reverse 2 decades of malaise on and off, deflation, recession, has big economic and political obstacles to reform, and right now they're incurring very large fiscal drag. And then the UK has surprised itself. Economic growth is exceeding expectations, which is boosting all the confidence measures. Inflation is near target. So those are the underlying conditions. Now, I'd like to emphasize an important clarification about a misperception about deflation. Policymakers and most analysts assert that low inflation or actual deflation is necessarily harmful for economic performance. This assertion is not correct. If the source of, say, deflation is insufficient demand and expectations of deflation become embedded and deter consumption and investment, then it very well could reinforce weak aggregate demand. So if it becomes embedded in expectations, then it's negative. Witness Japan in the 1990s and up until recently. If, however, deflation or low inflation do not have negative feedback on expectations and aggregate demand, then they're not harmful. In the United States, low inflation may reflect technological innovations and positive productivity shocks that contribute positively to economic growth. Is that bad? Is that something we should fear? That inflation is only 1%, but it's 1% because of technological advances? Low inflation may also reflect, say, the necessary wage and price adjustments that are going on in Europe. maybe it's unavoidable. So I call into question this absolute fear of deflation, that it's necessarily going to upend economic performance. I think it's open to question, and there's a clear misperception there. Now, I'd like to look at the U.S. and the Eurozone. In the U.S., nominal GDP is 4% year over year and accelerating. It's comfortably above potential. Real growth, real performance is strengthening. You have the tremendous amount of monetary stimulus and diminishing headwinds and fiscal drag. With nominal growth comfortably above potential and accelerating, the probability of deflation is close to zero. I would say inflation is going to increase. The Federal Reserve, in its forecasts, have inflation rising asymptotically toward 2% and then stopping exactly there. I think you're very likely to get an overshoot, maybe not right away, but eventually. In contrast, Eurozone nominal GDP, even though it's picked up, has picked up to slightly below potential growth. You're at early stage recovery with these necessary adjustments in real wages and prices going on that are inhibiting expansion. So if nominal GDP is barely up to potential, we shouldn't be surprised with inflation coming down there, and the probability of deflation due to insufficient demand is a serious possibility. And so the one positive I could say about Europe is the economy is growing, and as inflation has come down, confidence measures have actually gone up, so that the lower inflation or the risk of deflation has not become embedded in economic behavior. That's a huge plus. Now, this just shows nominal growth over the last couple of years, and you see in the UK and the US it's 4% and accelerating in the US, and in Japan I'm going to show another chart on this in a bit. It's positive now, about 2.5%, and the Eurozone nominal spending is very, very weak. Now, if you dig into the PCE deflator that the Fed focuses on, it's quite interesting, because what you see is the PCE deflator for services is stuck at about 2%. Meanwhile, the PCE deflator for non-durable goods is declining, and the PCE deflator for durable goods is declining. A lot of these declines, if you dig in, are due to technological innovations leading to lower prices that are positive for the economy. Okay? What's the big concern about inflation being below 2% because of positive technological innovations? Now, this represents a change in relative prices, but I think it's very, very important to dig into the reason why inflation is lower. If it had not been for the decline in prices of durable and non-durable goods in the last couple of years, inflation would be moving right along 2%. Now, once again, Japan, different issue. This chart is so dismaying, because what it shows is nominal GDP in Japan is at the same level now as it was in 1991. The only reason why real GDP has increased is you've had a persistent decline in the deflators. Okay, that reflects insufficient demand relative to productive capacity. And that has become embedded in expectations, and that's what Japan is trying to change now. Now, observations on Japan. Right now, nominal GDP growth is above potential following 2 decades of no growth. Real GDP is growing okay, but there's significant uncertainty, the fiscal headwinds of the higher VAT tax, and we haven't seen any true pro-growth economic reforms coming out of the Abe administration. I'd say the outlook is look for inflation to stay below 2%, but excluding the VAT tax, the one-time impact on the general price level. I think you could expect inflation to stay, 1.5%. But here's the concern in Japan. Inflation has gone up that has reduced real purchasing power, but it has not become embedded in inflationary expectations yet. So they have the worst of all worlds, and that's undercutting the propensity to spend. And so things are very dicey there. And as I'll come to, the BOJ can't do it alone. They desperately need economic and regulatory reforms. Okay, in the UK, everything is looking up: consumer spending, housing, business investments strengthening, the outlooks for continued strong growth and rising inflation. Now, to the U.S., the need to normalize monetary policy. As other people have emphasized, I think Bill articulated it the best, the economy is weak now and has been for a couple of years, has nothing to do with monetary policy and everything to do with non-monetary factors, real factors that have inhibited growth, including demographic factors, government policies, and the like. Our central bank continues to emphasize that all we face is insufficient demand. It's a cyclical problem, so just pump in more money. It's not working. One shouldn't be surprised that QE2 and QE3 have not worked. Meanwhile, the Fed's policies are generating significant distortions, both domestically and internationally. They pose significant long-run risks. Well, I don't think they're helping the economy that much. In fact, I'm convinced they're not helping the economy nearly as much as the Fed would like us to believe. It's just taken time for the economy to repair itself and the non-monetary factors, those headwinds to dissipate. Once again, I want to emphasize the role of technological innovations and the internationalization of the goods and labor markets that have suppressed inflation below the Fed's 2% target. And when I look at the dots and see the Fed tell us that it's appropriate to keep the real funds rate at 0 through the end of 2016 when the economy's back to full employment, I think that's irresponsible central banking. Now, this point I think is worth an asterisk rather than a dot. The commonly held notion, you read it in the Wall Street Journal and New York Times, and it's, well, the central bank faces this huge dilemma. If it raises rates too early, it will abort the economic recovery. Now, look through history. The best example, we talked about it earlier, mid-90s, the Fed raised the funds rate 300 basis points to preempt higher inflation. Inflation stayed flat, so it was all a rise in real rates. Okay, there was no forward guidance. I've gone back and read the minutes, I've read the policy, there was no forward guidance. Yeah, increase in 300 basis points. The stock market was flat, bondholders got hurt, the economy slowed for 2 quarters, and then it reaccelerated. Real or inflation-adjusted 10-year bond yields were 4.5%, and it was the interest-sensitive sectors of the economy that led the reacceleration in growth. Okay? So the funds rate was 6% relative to the 3% inflation. Real bond yields were higher, and it was the interest-sensitive sectors that accelerated the most. Go back to 1983, and real interest rates were even higher, about 5.5%. And it was the interest-sensitive sectors of the economy, particularly capital spending, that led the recovery. It was only when the Fed, they looked at 1994, which even the Fed perceives to be its best soft landing ever when it hiked rates. It was hugely successful. It generated huge credibility for the Fed. And Greenspan decided in the early 2000s, we didn't like that episode. We didn't like what it did to bondholders. So beginning in 2003, they started forward guidance before the term even became part of the monetary policy lexicon. They used the term measured and everything else. They were too successful. So actually bond yields rose slower than inflation. Real bond yields fell from 2004 when they started hiking rates to 2006, and it ended out generating huge distortions in the composition of economic growth, the housing boom, the mortgage-backed boom, and all that. So once again, we want real interest rates to rise to reflect stronger real growth. It's inappropriate and distorting when you prevent it. And I just shake my head when I see the Fed and everybody else talking about, oh, if we raise rates by that much so that they get closer to zero from the negative side, it's going to abort the economic recovery. That's absolutely inconsistent with history. So I urge the Fed to accelerate monetary policy normalization, not just establish a strategy for unwinding its balance sheet, not rolling over the proceeds from the maturing bonds, but hike rates. And I just urge them to do so. They won't. The Eurozone. So the ECB forecasts sustained growth. Actually, economic growth in Europe has beat the ECB's forecasts, and they also have inflation going up to 2%. A lot of the financial risks have abated, but I'm going to fast forward here. What I do here is I show the central bank's balance sheets, and I allow fourth quarter 2007 to equal 100. And you could see the Fed's balance sheet has gone up nearly fivefold, so divide that by, so it started out as 900 billion and now it's 4.5, the BOEs. But look at what's happened to the ECB's balance sheet. Okay, as banks have repaid their LTRO, their loans from the ECB's balance sheet is shrinking. Okay, so effectively, it's shrinking at the wrong time, and European banks' lending is declining, both due to weaker demand, but also due to supply constraints, in part as European banks raise their capital ratios, setting up for the AQR and the stress test, which now is being conducted by the ECB and the EBA, and they're taking it seriously. So the LTRO money, the loans, like about €1 trillion of loans made by the ECB to banks, made a couple of years ago, it's due to expire at the end of this year. About half of it's already been paid back. It's due to expire. So the ECB's balance sheet is going to shrink further. They do run the risk with nominal GDP slightly below potential and need for a lot of adjustments. There is this risk of deflation due to insufficient demand. And Europe really can't afford that now in light of all the ongoing adjustments it needs time. Okay, so I recommend that the ECB replace the LTRO with a QE, and I applaud the ECB for, absolutely unlike the Fed or the BOJ, I applaud them for urging the fiscal, regulatory, and economic policymakers to clean up their acts and move toward reform. The Fed has been absolutely remiss here. And talking about remiss, give me 30 seconds here. The BOJ is absolutely under the thumb of the Abe administration. They have massive QE now. It pushed down the yen. That had a one-time impact on profits. There was almost no follow-through to Japanese exports. Now you have the fiscal drag. There's calls for another round of BOJ quantitative easing. It wouldn't help much. They desperately need just so many economic and regulatory reforms. But here, the BOJ will do what it's told, so I would expect another round of QE, but don't expect much economics out of it until the Abe administration not just talks about, but really puts in place some true reforms. That's it.
One question? There are two. Well, Kathy, we'll let you get a question in. You need the microphone.
You're suggesting that the ECB buy sovereign debt. What they're planning on doing, it appears, is to try to buy up, create packages of private sector lending, and because banks are so much more important over there even than they are here, what do you think about that strategy as opposed to the sovereign debt?
Two comments. I think, yeah, I mean that's they are considering a whole host of possibilities, but one, the asset purchases. First, from within the ECB, politically, I think there would be some significant opposition to that proposal, particularly from the Bundesbank. And then it would be an issue of, and they would say, let's stick with monetary policy and not credit policy. And then economically, I think banks have more than enough liquidity. They've raised their capital ratios a lot, and I think the better way to go now is just by buying sovereigns, a very traditional QE, and then the issue is what duration, and I would rather have them stick to the shorter side of maturities than what the Fed has done. But what you've mentioned, the buying up packages, which would lead to big credit risks. The issue is how much would it help open up the banking channels to provide loans, and I don't think at this stage very much. Now,
You have to create a loan for it to become an asset-backed security. Given the bank's credit clearly has not turned into loans, so this is a way of shoving it down their throat, which might be necessary since they're not eating it and chewing it.
I understand.
It doesn't like buying sovereigns either, so you're not going to make them happy either way.
Wish we had that on film since you don't have a microphone. Why?
Interesting, and let's speak about it afterwards.
Thank you.